We're joined by Matt King, Global Head of Strategy at Citigroup. Where is it then?
The trouble is the credit markets remain inextricably linked with the sovereigns, and even though, I guess the most striking thing at the moment is the way different markets price different amounts. So the disaster being priced by the government bond markets is kind of slightly priced into credit and not very much priced into equities at all. So credit is pricing in a normal type of recession. Eventually, once we get through the European sovereign problems, we do think spreads will tighten. And yet I have to say that these good auctions we've had recently, we're really quite suspicious as to whether that can last. And our guess is that markets need to put governments under a lot more pressure still before we will eventually get that resolution.
So there's more damage to come, is essentially what you're saying, or more volatility to come?
Definitely volatility, and almost certainly a lot more damage even before that.
But Matt, in terms of, just from a very practical point of view, we were speaking to the chief executive of Diageo a little bit earlier on, and the problem is that a lot of these times they're actually thinking of, if we lose the euro, if someone's leaving the euro, what do you do with all of these bonds, be it sovereigns, being credit? Is this now the point where actually investors have to say, if I buy this in euros and the euro disappears, what am I left holding?
Unfortunately, investors are having to ask themselves that question, both about their bond holdings and frankly about deposits, and it is concerning to see how deposits are migrating from the south of Europe to the north, and frankly out of Europe to the US. And this is very dangerous because it can accelerate really quite quickly. And I guess it's our greatest concern that policymakers have consistently underestimated the importance of confidence and how these things can accelerate and get out of control.
Matt, what's the chance of the euro not surviving in the next 3 months?
Complete breakup still seems very unlikely, so let's say less than 10%. That said, scope for some countries to greater capital flight and eventually some countries to end up leaving has increased from 5% to maybe 20%. It's still not our best guess, but even the scope for that uncertainty is alarming. And what's more, because of that possibility, even if it's going to survive, again, the chances are you get some kind of escalation of this, quite possibly with, say, Italy or other countries being shut out of the bond market entirely in the course of the next 2 or 3 months.
You just said that there's a duty to keep governments sort of under pressure, and surely the market's there to make money. It's not there to sort of like tell various sovereigns what they should be doing and when.
It's not that it's a duty to keep them under pressure, but the trouble for bondholders is that your upside is always getting back the original money. Your upside is always par and then a few coupons. And that you always want to know you're going to get back par. And the moment you're not short of that, the temptation is to run for the exit. It's just the rational thing to do. And what we've said is that govies are going through the same process that we have in credit when credits go down from high grade to high yield. Even if you think it's cheap, you start looking at how much you've got. And you say, maybe my risk on this is too large. And as people look at their government bond holdings, in credit you never have more than like 2% for a particular credit. European government bond investors have 25% of their portfolios in Italy. Even if you think that's cheap, you start saying it's too much, you start reducing your exposure, and then it becomes self-fulfilling.
So Matt, how do you make money in this environment? Do you have to look to the US or even in countries outside the Eurozone? Or if you have a strong stomach, do you stay in the periphery countries and you say, I'll ride it out, and if the euro survives, I'll make money?
I think more than anything you trade the dislocations. So yes, you can flee away if you like, but mostly you try and trade these dislocations. So at the moment, what's alarming is the markets closest to the problem that are supposed to be being fixed, things like government bonds, are showing least sign of responding, and it's equities and it's the US and so on which are rallying the most. Frankly, we think that that's misplaced. And so you're kind of in an environment at the moment where if you're bullish on the world, you buy Italian government bonds. If you're bearish on the world, you sell everything else, and in particular those things further away, which have actually priced in much less.
Now, one of the key aspects of everything that we're seeing right around the world right now is deleveraging, whether it's sovereigns, whether it's corporations, whether it's personal. What are the investment implications of that now going forward?
For the longer term, I think that's almost the scariest thing. So what we are trying to do, reduce debt across the public and private sector, has not been done by any single advanced country in any decade in the last 3 decades. And now we're trying to do it across almost all the advanced countries at the same time. There have been plenty of episodes where governments have delevered successfully, but it's always been offset by the private sector leveraging up. And now you're not getting the private sector leveraging up. And it's very difficult to see how we're going to do that successfully.
Are big banks a cure or actually a curse for the global economy?
I think that We do not expect any bank to fail in the way that any large bank to fail in the way Lehman did. We are worried about shortages of collateral in the Eurozone, but you can see the central banks are determined to come to the rescue. That said, as banks delever, and as the private sector delevers, so again, I don't know that I blame it on the banks, but that process of deleveraging is going to prove much more negative for growth, much more negative for asset prices than I think people generally tend to realize.
All right, Matt, thank you so much for your time. Matt King, their Global Head of Credit Strategy at Citigroup.
Yeah, fascinating stuff indeed. Now,